going to take a minute for people to come in.
Looks like people are slowly starting to come in. Welcome, everybody. Give it a couple of moments here as people trickle in through the virtual hallway into their virtual seats. Welcome, everyone. See, the numbers are still climbing, so just give it a minute here as people continue to come in. All right, so let's go ahead and get started. My name is Jared Jones. I'm a lead advisor and also the director of investments here at Omega Wealth Management. Today we have Matt Potter from SEI. I will get to his introduction in a moment. Today we're going to be overviewing some of the interesting things going on in the markets and the economy. There is no shortage of things to talk about. I know some of you have questions, perhaps concerns about where we've been and where we might be heading. Matt and I have discussed beforehand some of the different topics we're hoping to highlight around how SEI is positioning accounts and just some of the unique things happening this year to make it truly a unique year. So without further ado, let me first actually go over some housekeeping notes. I believe if you hover at the bottom of your screen, you should see a couple of different options and buttons. The Q&A button is the one that I think most of you will be curious to find. So if you can find that at the bottom of your screen, feel free, as Matt is going through his presentation, to put your questions into that, and I will be taking a look. We're going to hold questions until the end. Matt's presentation will run about 30 minutes or so, but he did mention he could go 2 hours, so we'll try and hold back from having that happen.
But I won't.
Yeah, so we want to give plenty of time for questions at the end, so we're focusing on the areas that you want to focus on. So please do not hesitate to send in your questions. So without further ado, let me introduce Matt Potter. Matt Potter is the Director of Investment Services with SEI, our investment partner. Matt's responsible for supporting the delivery of advice-driven asset management solutions for financial advisors like Omega Wealth Management using SEI's solutions. So this includes custom investment case analysis and proposal to support advisors, as well as technical investment support for financial advisors and relationship managers. Matt also is a regular speaker at SEI and advisor-sponsored events like this one tonight. So he's well-versed in talking about all things economy and financial market. Matt's been with SEI since 2013, although he has 25 years of experience, and he has a great story around. He was sitting on the other side of the table from SEI at one point during his career with Lockwell Investments, a boutique small cap value investment manager. So he's got some real experience over security selection and that side of the business as well. And before that, he worked for Morgan Stanley and as a performance analyst with Janney Montgomery & Scott. Matt is a chartered financial analyst. He holds that. It's the highest level of certification within the investment world. And he's also a member of the CFA Institute and CFA Society, holds a Bachelor of Arts from Haverford College and a Master's in Psychology from University of Pennsylvania. So with all of that in mind, I will turn it over to Matt, and I hope to learn a little bit more myself about some of these strange times. So take it away, Matt.
Great, thanks a lot. Thank you everyone for joining us this evening. And as Jared mentioned, there are plenty of things to talk about. I will try to cover a decent amount of ground, but also allow time for questions at the end. What I thought I would do up front is just give a little bit of a reminder or introduction to those of you who maybe don't quite know as much about SEI as you'd like. And of course, even though we've been doing this for a couple of years, it still is taking a while there we go. Okay, so just a few words on SEI. So we have been around for more than 50 years. We are a publicly traded company. We've been that way since 1981. I like to say we are one of the biggest companies that a lot of people have never heard of in the investment world. Between our different divisions, assets that we manage or advise or administer, it's over $1.3 trillion, which a number that still amazes me every time I see that. We started as a technology company. We provided services to bank trust departments, and we still have large relationships with 10 of the 20 largest US banks, about 4,000 people across the globe, most of them in our headquarters, which is just outside of Philadelphia, but we do have people in other countries as well. And we've been working with independent advisors for over 25 years. This is important because we don't really want to push product out into the marketplace and just see who buys it. We want to partner with advisors who know their clients, really can come up with solutions that work for them, that are suitable for their goals, and do it that way. So that really is our approach. We also have an institutional business where we work with a number of different clients. These are some of the representative clients that we have, just to give you a sense that the money that we manage for larger firms, we manage for individuals, and we really take external money managers and curate them. We evaluate them, figure out which ones we think make the most sense for portfolios, and then we try to make them available not only to our large institutional clients, but also to individual investors, whether it's through separately managed accounts or even through mutual funds. So if we like a manager, we want to use them everywhere. We don't want to just have kind of our high quality portfolios for the big institutions and the maybe more mediocre ones for individuals. We want to, if we like a manager, we want to be able to use them really across the board. So with that, I will get into talking about this year. What I thought I would do is start with kind of an introductory slide. I tried to think of a good word for this year. I came up with abnormal. Maybe that's the psychology part in me. You could come up with plenty of other words, some of which may not be suitable for print, but it has been really unusual this year. One of the reasons being we have a year where both stocks and bonds have had negative returns. In fact, we've had 3 consecutive negative quarters of returns for stocks and bonds. That typically does not happen. If you look back since before the Great Depression, there have only been 2 other calendar years, 1931, 1969, when both stocks and bonds have been down. Usually one will act as a good diversifier for the other. So what we've seen this year, and we've also again, with 3 negative quarters of returns, it's the first time for stocks since the global financial crisis, and it's the first time we've seen that for bonds since the Jimmy Carter administration. So the kinds of things we're seeing this year, very much an anomaly, which hopefully means it doesn't last too long, and hopefully means that it's not the kind of thing that turns into a long-term trend. But every now and then you do get strange years like this where it seems that nothing seems to to be working. I looked at a little more detailed at kind of individual years going back to 1976 when we had data a little bit more easily available, and we can see that stocks fell in 8 calendar years, but that stacks up against 38 years where they gained. So a good ratio of up years to down years. But certainly when you look through, you can see the only time we had consecutive down years for stocks was 2000, 01, and 02. Otherwise, they're kind of a little bit more spread out. And when you look at bonds, since 1976, we've only seen 4 years of negative returns and never consecutive years. That may come to an end this year because the last year that we saw a negative return was last year. But that stacks up against 42 years of positive returns for bonds. So again, typically we see much different patterns than what we've been seeing this year. One of the reasons for bond returns has been because of inflation, which has caused the Federal Reserve to need to raise interest rates, which kind of goes against what the bond market wants to see, at least in the near term. And so we look back, before this year, the worst year since 1976 for bonds, that was back in 1994. And that, just like this year, was also a year when the Fed raised rates a lot in a short period of time. Back then it was 7 times in 13 months. Although the magnitude of the raises we've had this year has already hit what the Fed did back then, and we're probably going to go past it. And even then, the return for bonds was down just about 3%. This year, it's more like in the negative 15% range. So if you feel like this year has been unusual, you're right, because in many ways, it really has been kind of unique. This year, the Federal Reserve, again, in response to inflation, has taken action and has the one thing that the Fed can do to counteract inflation is to raise interest rates. It's kind of a blunt instrument. The idea is to slow down the economy, slow down the demand side of things to help prices level off and head downward. And so the Fed has raised rates their last 5 meetings. They started with an increase of 0.25%, then they went to 0.5%, then they've had 3 increases of 0.75%. And it looks like, based on where rates are right now and the target that they expect them to be at year end, we will likely see more increases through this year and possibly a couple next year. One thing that's been interesting to me is, and I'll talk a little bit more about the midterms when we get there, but often when there is an election, the Federal Reserve will kind of want to go on pause. They don't want to necessarily take action close to an election and make it look like they're maybe putting their thumb on the scale to favor one side or the other. This year, however, they have a meeting coming up in early November before the midterms. There's been no indication that they're going to pause. To me, that just kind of highlights how important it is for them to really break the back of inflation and make sure that inflation expectations in the market calm down. That, again, their highest priority, and to me, that just kind of underscores the commitment to that. So with everything going on this year, high inflation only made worse by Russia's invasion of Ukraine, the various issues that China has been having with COVID on the manufacturing side, and just our overall economy's adjustment to going from a complete or near complete shutdown because of COVID and then a quick restart. Our economy wasn't really engineered to do that. So we've had bottlenecks, supply chain issues. All of those factors have really contributed to inflation. And so the sum total of it is, it has been a tough year. We look at the year-to-date returns here for stocks across the board. Up top, we see mostly US stocks, and towards the bottom, international and emerging market stocks. And you can see that, year to date, we've seen declines in the, call it 24 to 25% neighborhood, broadly speaking, for US stocks. That does technically constitute a bear market, and I'll have a little more to say about bear markets in a couple of slides. We've seen slightly more negative returns outside the US. Part of that is due to some of the headline news that we've seen in other countries. Part of it also is due to the strength of the dollar, which tends to make US assets more attractive than overseas ones. But the area where we've seen some differentiation in returns has been by style of investment. I've talked about this before, where we look at growth versus value. Growth stocks, generally speaking, they're companies that are expected to grow faster than the economy, faster than their peers, often in areas like technology or companies similar to that, and they're often more expensive. Whereas value stocks tend to be cheaper. You aren't paying as much for a future stream of earnings from them, and they often tend to be in more old economy areas, more defensive areas. And there are periods where growth does better. There are periods where value does better. We had been in a period after the global financial crisis where growth really ruled the roost for quite a while. It seems like we have hit a sea change. This is something we have been looking for a while, where we think value is well positioned going forward, not necessarily for the next quarter or two, but it could be a multi-year trend. Part of that is because when you have an inflationary environment, it does tend to hurt growth stocks more. That future growth that you're buying, that you're paying up for with growth stocks, isn't worth as much. And so more expensive stocks can get hit a little bit harder when you have an environment that is suddenly changed to an inflationary one. So you can see year to date, large value stocks, small value stocks have done better than their growth counterparts, even though that trend reversed a little bit in the third quarter. And that's an area where we've generally been emphasizing or tilting towards within many of our funds and strategies. So that's one of the ways that we've tried to position things for the kind of year that we're seeing and what we think we may be seeing moving ahead. Looking at sectors, I talked about kind of the difference between growth and value. And here we can see sector performance. The light blue bars are for returns for the past year. The dark blue bars are for the third quarter. And you can see that for the past year, by far the strongest sector has been energy. Certainly makes sense. We've seen higher energy costs, oil prices, gasoline prices, and kind of based where how low energy prices went during the pandemic and how they had stayed at pretty low levels, it does make sense that the year over year rate would be higher. Other sectors that have either gone up or held their own recently, again, they've been some of those more defensive or value sectors like utilities, consumer staples, healthcare. Some of your classic sectors that investors often will go to when markets become more volatile. Because they see their earnings as more stable, they see their valuations as being less expensive, and at the expense of the more expensive growth stocks, which you see kind of at the bottom. Technology, consumer discretionary, which there are many companies that are tech adjacent, such as online retailers, and communication services, which that used to be just phone companies and others, but it's expanded into areas like media, online media. So again, another kind of tech adjacent area. And as I mentioned, we do think that the performance of value versus growth, we do think that value may be in for a longer period of outperformance as we move forward. Not to say that we expect it to do better, every quarter consistently, but over the long haul, we do think that the positioning of value is favorable. And so that's where we have tried to emphasize. Now, I talked about being in a bear market, which is defined as a decline peak to trough of more than 20% in the stock market, usually the S&P 500 index. We looked back at historic bear markets, and we also looked at the recoveries because at least so far, every bear market has been followed by a recovery. When you look back to 1929, so this includes, the Great Depression, the median bear market has been a loss of about 33.5%. I mentioned this year that the peak to trough decline has been in the 24-ish% area. So it hasn't dropped as much as we have seen in median bear markets in the past, although it has lasted about 9 months, and that puts that time frame kind of similarly in line with the median. But I would point out the median here includes the Great Depression, which is at negative 83%. It includes some other more severe outliers, like the global financial crisis. So if you were to look at kind of the level of severity, if this is one of your more, let's call it run-of-the-mill, and even though I know it's not pleasant, but kind of one of your more typical bear markets, then maybe 24% does represent a lot of the decline. We may or may not be at the bottom. We don't know. We're not going to know until we get further out in time. But it does seem at least plausible that the bulk of the pain may already be behind us. And as I mentioned, when you look at the recoveries that have happened after bear markets, they have been longer and stronger than the declines. Markets usually spend most of their time going up. Remember the statistics I showed on one of the first slides. So when you see the gains that happen, the median gain is about 77.5%, and it lasts about more than twice as long as the median bear market. So knock on wood, again, we don't know exactly what's going to happen in the future, but if the past is a guide, then I think the reward that you get for staying fully invested during a bear market, because it's very difficult to time when they're going to end, the only way that you can be sure of getting the benefit of the full recovery is by being fully invested. So at least there does look to be reason to hope, at least based upon history when we've looked at prior bear markets. I mentioned the severity of inflation, and we wanted to look at that in a little more detail just to kind of show how big an outlier this year has been, not necessarily relative to long-term history, because we had very high inflation in the 1970s, for example. But when you look at where inflation has been, say, since the 1990s, and particularly since the global financial crisis, it has been at pretty low levels. This is the Consumer Price Index, which is one common measure. There are two ways of looking at it. There's the core, which is the green line, which excludes food and energy because those are more volatile sectors. And then there's the headline, the blue, which includes food and energy. And whichever measure you look at, they both are at quite elevated levels compared to where they were even just a year or two ago, and certainly compared to where they were during the COVID shutdown. Now, again, this is a situation that the Federal Reserve wants to see price stability. They don't want to see prices increasing on a year-over-year basis to this extent. So the way they respond, again, is by raising interest rates. The problem with that, though, is when rates go higher, the values of bonds go lower. Bonds do not respond well to longer periods of inflation. They also don't respond well to rising interest rates. And so when we look at those two together, it makes sense why bonds are down so much this year. Bonds are not a monolith. There are a variety of types of securities, whether it's US government bonds, corporate bonds, tax-exempt municipal bonds, bonds from outside the US. And you can see most of them have been in fairly negative territory year to date. Again, especially bonds from outside the US because of the strong dollar. The chart on the right, I think, also illustrates this. This is the yield curve for US Treasuries. I'll explain the yield curve. When you think of a bond, just think of it as an IOU. You're lending money to the Treasury, the US government, for a period of time. Let's say you're giving them $10,000. It could be for a month, it could be for 5 years, it could be for 30 years. And while you're waiting to get your money back, you're getting interest payments, typically twice a year. And when you finally get your money back, that's when the bond matures. If all is well and they're good for the credits, you will get your full $10,000 back. Now, normally, and this is just a plot of interest rates that you get paid for bonds of differing terms. So again, a short duration bond, and the light blue line was from a year ago. A short duration bond, 1 month, you got pretty close to zero, not a whole lot of interest. As you went further and further, the longer the duration bond was, the higher the interest rate was until you got out to 30 years. Now, fast forward a year, that's the line up top. The first thing I'd highlight is this line has gone up a lot. This is a very big move within bond markets, this kind of increase. And another thing you'll see is that the shape of the yield curve has changed a bit. Normally, it's upward sloping. So again, shorter duration bonds, lower interest rates, and then as you go to the right, the rates go up. Well, now it kind of peaks a little bit at the midsection, and then it begins to go down. This is referred to as an inverted yield curve. And in the past, economists have looked at it because typically it has been a good predictor of recessions. Normally, when you see the yield curve invert for a full calendar quarter, or a full 3-month period, I should say, that has been followed by a recession anywhere from 6 to 18 months later. Our base case is that we do anticipate seeing a recession within the US, possibly sometime next year, and that would be consistent with the message that the bond market is giving us. Now, again, this is kind of the frustrating part, because when you have a quick move like that, it really does have a negative impact on values of your bonds. But it also means that interest rates are higher, and now you can get higher rates from things like money market accounts, or if you were to be a buyer of new bonds today. So from here, as we look forward, bonds do offer more yield than they did a year ago. And that's one of the things that tends to determine values of bonds over longer periods of time. And normally, the higher the bond yield is, the better your future return is going to be. So while it was painful to get here, at this point, and at whatever point we get where the Fed stops raising interest rates, bonds may start to play the role that they used to. Again, highly unusual year where both stocks and bonds are down at the same time. Normally, bonds can act as more of a cushion to your portfolio. And I think with rates having gone up as much as they have, hopefully this does return bonds to their kind of more traditional role within portfolios. Now, to look at our economic outlook, I'll go over a couple points, and I've mentioned some of these before. But as we look at things, we think that inflation probably has peaked or is in the process of peaking. So we do think that the Fed will be successful in slowing the economy and helping to bring inflation lower. But we don't know that it's going to come down as fast as the Fed is projecting in some of their estimates or the market is projecting. We think that inflation may come down a little more gradually, and we think that it may kind of get to its terminal point at a higher level than the level that maybe is currently priced in. There are some elements of inflation that have already started to recede, things like oil prices, used car prices, things like that. But there are also elements that may be higher for longer, like wages. This has been a very strong labor market within the US. That has meant that employees can demand higher wages because there are something like 2 openings for every one unemployed American. And generally those increases tend to be fairly sticky. And there are some other elements too that may be a little bit more longer lasting. So because of this, part of our positioning within some of our strategies, and we have a number of different strategies, so any comments that I make about how we're positioned, it's going to depend really on what the specific investments are that you have. But we are big believers in diversification. And one of the elements of diversification for us has been inflation-sensitive assets or inflation hedges, those kinds of investments like commodities or inflation-protected bonds that can do better in a period of inflation. We do have some positions within that realm, which we've had longer term in strategic portfolios and which we've leaned a little bit more towards more recently. So that's another way that we've been looking to position portfolios for the environment. Now, when we look at stocks, one of the things that typically drives stock prices over the long haul is corporate earnings, corporate profits. Those generally have been holding up, I think, better than people have expected. But again, we do expect to see the economy slow. Even if we don't go into a recession in the US, we still do see earnings coming down. We see profit margins coming down. So that should, by definition, lead to some negativity within stock markets. But again, we've seen that this year. If you assume that in a moderate recession, a mild recession, maybe that hurts corporate earnings, 20%, maybe a little bit more. Well, stocks already are down a little more than 20%. So we've seen the stock market kind of anticipate that slowdown in earnings. I think it raises a good point that markets are forward-looking. They don't necessarily price for where things are now, but they price for where they expect to see things going in the future. And there will come a point where things have been oversold and markets kind of see things as turning around, maybe not immediately, but they may begin to recover even before the economy itself has started to improve. That's one of the reasons why it's so hard to time markets, because you never really get an all clear signal that now is the time to invest. Usually the best time to invest is when no one else wants to invest and when it's hardest to get back into the market. And it makes it really difficult to do that. So again, we think staying fully invested as opposed to trying to pick when you go out of the market, when you go back in, staying invested, we think tends to be a better strategy. Now, we did have a little bit of a rebound back in the middle of the year, around mid-June for a couple of months. Stocks did come back up a bit, and we wouldn't be surprised if we saw another type of relief rally, because things were pretty oversold as we got to the end of September, kind of like they were around mid-June. So you might see some positive volatility in markets. You might see some negative volatility, but we do expect to see, continued volatility, probably until the Federal Reserve ultimately comes out and gives some indication that they're close to done with their rate hikes. That said, overall, there are things to be concerned about. We do think that Europe in particular is going to be entering a recession if they're not already in one. They certainly face higher energy costs than we do, and they are a little more challenged to try to help individuals and corporations deal with these higher energy costs. And they also are having a tough time giving that support on the one hand and fighting against inflation on the other. So they definitely face some challenges. We think that, again, the short-term trend probably, or the medium-term trend still seems to be a negative one, like it has been this year. Again, not to say that we may not see some, up and down markets as we go forward, but again, until we get to the point where investors are confident that the Federal Reserve has done its job and has successfully started to bend the curve of inflation and change inflation expectations, I think that kind of uncertainty probably will weigh over the markets and could keep things from rallying, at least kind of in the near future. But that said, I think it is important to realize that even in environments where markets are down, there are things that you can do for your financial situation that can be positives. One thing, for example, is tax loss harvesting, where you take assets that are down, that are selling, or that have a capital loss within them. They're priced lower than what you bought them for. And if you sell them, instead of being taxed on the profit, now you have a loss that you can use to offset profits elsewhere in your portfolio. And that can help to lower your overall tax bill. So that's something that we've seen many advisors, certainly Omega has looked to do that. And there have been opportunities to automate that, as well as to do that manually. So that is one thing that you can do to position portfolios to at least kind of take advantage of the volatility, still staying invested, but now creating a more tax efficient portfolio for the future. Now, one other topic that I wanted to get into briefly before turning to questions is the midterms. We are facing midterm elections. I am a bit of a political junkie, as I've probably mentioned several times before. And I think it's interesting to look at why should people care about midterms, because throughout the country, there are a lot of people, some who don't even know that we have midterm elections coming up. But it's important because midterms, especially when you're looking at the first term of a presidential administration, very often it is a point of reversal. We look here at going back to the Eisenhower administration. During the first presidential term, the first midterm election that has come up, you can see in every one of those, with one exception, the House of Representatives, the incumbent party lost seats. In some cases, it was 40, 50, or 60. The only exception was 2002, probably due to the impacts of September 11th. And when you look at the Senate, it hasn't been quite as one-sided, but there have only been 3 instances where the incumbent party has actually gained seats in the US Senate. So typically, you see the pattern: one party gets elected, they take the White House, and then maybe they haven't instituted enough change, or maybe people are dissatisfied with conditions, or the people who are enthusiastic for the presidential election don't want to come out for the midterm. Whatever the reason is, often you will see a reversal. It could be a referendum on the current administration, or it could just be a different pool of voters who are turning out. So where we are with respect to the current landscape is, As you probably know, there are 435 seats in the U.S. House of Representatives, so you need 218 for a majority. Democrats just barely have a majority right now. Based on some of the polling that I'm seeing from some reputable third-party organizations, it looks to be more likely than not that the House will follow history and shift from Democratic control to Republican control. Again, not a sure thing, but it does look like more than a 50% probability. The Senate, you've got 35 of those seats being contested, most of them Republican seats. And right now, it is a 50-50 tie with the vice president serving as the tiebreaker. So it's very close. And it does look like, while it may be more of a coin flip, the odds may be a little bit in favor of Democrats keeping control of the Senate. Governor's races are also important, I think this year especially, because we've seen with legislatures from different states, they've become more important in a couple of ways. One, with respect to abortion with the Dobbs decision from the Supreme Court. The other with respect to voting laws, how votes are counted, all those kinds of things which may have implications 2 years from now during the next presidential election. So those certainly are worth watching as well. But one question we get is, okay, should we change our portfolio positioning depending what happens? What if there is a change in the House? Is that going to be good or bad for stocks? Well, there are different ways you can look at it, but one way is if you go back to 1901 and you look at all of the presidential administrations and break it down into either Democratic president or Republican president, and then are both houses of Congress the same as the Democratic Party, or is it divided government? And when you look at the performance of US stocks represented by the Dow Jones, which is the blue bar, you can see the best scenario historically has been a Democratic president and a split Congress. And that could be what we have if historical trends follow. Now, I think it is important to recognize that these do depend on what your starting point is, because you include the Great Depression, the Herbert Hoover administration, that's a big outlier on the negative side for Republican presidential administrations. And then you look at FDR with the recovery from the Great Depression, that's a big outlier on the positive side for Democrats. So where you draw the line, what your starting point is, sometimes can have an impact on the results. But I think no matter how you look at it, at the very least, divided government often is well received by markets and by corporate America. Maybe the thinking is that the less that can be done in Washington, D.C., the better, more likely to maintain status quo, fewer surprises, fewer major changes. And again, markets typically don't like uncertainty. Divided government may sort of narrow the realm of options that could come out in terms of legislative or regulatory changes. So with that, I'm happy to turn it over and take questions. We do have a few slides that I want to make sure that I show for our good friends in legal and compliance are always very eager for you to see. So I will flip through those, but happy to take any questions that you might have.
Yeah, great. And I've also just launched a quick poll for the audience just on what you think will happen over the next 6 months. So whether the market will rally at some point within that 6-month time frame, whether we'll have a flat market or we're in for more pain. So feel free to select your answer. I have a feeling I know where the majority of people will say, but we'll be curious to hear nonetheless. We did get a couple of really good questions come in throughout the presentation, but if anyone else has questions, please do not hesitate to respond. So the first question I think is really an interesting one around demographics. And whenever you read about market history and recoveries, there's always someone that says, okay, now do Japan. And with the demographics that they experienced, is stagflation a type of environment that's just going to be here to stay like it has been for Japan?
Yeah, and I would say, demographics certainly can have an impact on the overall economy. And we are seeing some of it with, the aging of the baby boomers in particular right now. But it isn't necessarily the only factor because, conditions do change. Where people live in their later years, for example, is something that has, evolved over time. Life expectancies have changed over time, most years, for the better. And, the types of lifestyles that people may lead in retirement have evolved over time. So while there may be some value in seeing how many people are in their prime working and spending years and what kind of boost could that give to the economy, that also is looking again primarily at the domestic spending patterns of consumers. Doesn't always take into account things like global trade, what's going on in other countries, and also, technological changes and things of that nature. So it certainly can have an impact, but I don't know that it necessarily, demographics is destiny. I don't know that it's necessarily quite as straightforward as that.
Yeah, great. Got a question about inflation protected bonds as well. I think in theory, those sound like a great idea. What we saw though this year is they did not hold up all that well comparatively to what people might have expected. So can you expand on those thoughts?
Sure. So inflation protected bonds, TIPS, Treasury inflation protected securities, they're a little complicated because they have a factor that's built into them to compensate for whatever the level of inflation is. And if inflation levels are changing as you go forward, there is a little bit of a lag. But another thing that's important is you're not just looking at where are inflation levels now, but what does the market expect? Because again, bond markets are also forward-looking. So the best time to own TIPS, Treasury inflation protected securities, is when inflation expectations are low and they go up. That really is when primarily you will see them perform the strongest. But once you have inflation, the changes in the future expectation of inflation, it isn't necessarily current inflation that's going to affect it, but also where's the trend. And again, if we think that the Fed is going to be successful and be able to slow inflation, that's something that can impact it. And they still are Treasury securities. They still are bonds, even if they are inflation adjusted. There still is a big downdraft in the bond market that has an impact. They're not immune from that.
Great. Yeah. And of course, there are also I bonds out there that have gotten phenomenal rates of return that are set for a 6-month time frame, right, Matt? And then they reset. So that's something to keep an eye on as we move forward. Although it's not all that fun, we found having clients go through the process of setting up an account on Treasury Direct, and,
yes,
and their website seems to be stuck in the 1980s or 90s. I don't know.
There's a little more work you have to do to earn that return. Yes.
Yeah. So great question coming from another one of our clients. It's easy just to focus on the US and some of the problems that we're facing. That's mostly in our news. What about the problems elsewhere, like the Ukrainian war, China's aggressiveness, and Iran's drones? How does that all play into our economy? How insulated are we from those considerations, and what are we looking for in the markets related to that?
Yeah, it's a really good question, because when you look at publicly traded companies across the globe, the U.S. represents maybe 62% of them. There are a lot of stocks, bonds, other investments that are from outside the U.S. Some in developed international countries, and some in more newer emerging that may have more potential, but also may carry more risk. There are a lot of different factors. And again, we're big believers in diversification. We think having some exposure to non-US securities often does make sense because there are times when US securities outperform, again, especially when the dollar is strong. But when the dollar weakens, that can turn into a tailwind for international countries. And if we assume that maybe some international countries, like maybe within Europe, if they go into a deeper recession before we do, then maybe they'll come out of it before we will, and their markets may recover sooner than ours. And there is so much global trade that, the impact, there's less sort of local impact on many securities than there was in the past. Countries aren't as isolated as they used to be. But certainly, that also means that when Russia invaded Ukraine, that affected oil prices, it affected agricultural commodity prices, rare earth metals. It destabilized Europe. There were a lot of refugees who fled into European countries, had to be taken care of. And that has implications for what kind of demand there would be from European citizens for US products. So there is a lot of interconnectedness. So I think, again, it is, we think it is important to be diversified. And also we think to focus on areas where you have some degree of expertise, or you're hiring someone who has some expertise, who really understands the economies, because not all economies act the same. And there are often little quirks that, you really only know if you've been involved in it deeply. Yeah,
great. So I think you made the case for value investing in some of the slides you talk about today. Can you just talk maybe for a moment about the importance of not going all in on value or not all in on growth, and why that's a difficult decision to make at times?
Sure. And I think this is sometimes one of the hardest concepts, because, in order to try to position a portfolio appropriately, you need to have a degree of humility, because, we may have expectations for how things are going to turn out, but we could be early, we could be wrong, we could get the direction right, but not the magnitude. There are a lot of things that can happen, and things can change. We certainly can see environments where even experts, may be all in on one opinion, and markets often will act in a way to embarrass the most number of people possible. So we think that, again, being diversified, not really making huge bets on one particular area, but maybe leaning a little bit more in one direction versus another can make a little bit more sense. But, as you look at growth companies, like within technology, for example, we're in a very different environment than we were in the dot-com bust era. A lot of the big tech companies are huge companies. They produce a lot of cash flow. They're very good businesses. They just may not be the best stocks right now, but it's not like these companies are likely to go away, and there still is going to be a lot of demand for their goods and services. So they will probably still continue to play a role in the economy. And there will be a point at some point where, growth once again becomes more favorable. So we think, rather than kind of take an all or none position, which is more like market timing, we prefer having a broadly diversified portfolio, but maybe looking for some select, being a little bit opportunistic in terms of how you tilt your portfolio, but also understanding there is a margin of error. And if we don't want to have a position where, if we get it wrong or the timing is off, it's going to, kill the whole portfolio.
Yeah, and we love to highlight some of the tilts that SEI has made within their ETF strategies and broader speaking in the managed accounts. So I think that is, and some of those tilts have actually paid off pretty well this year. So that's always fun to highlight for clients. I think now might be a good time to highlight the poll results here. So about 50% of people that responded said we're in for more pain. 33% said flat, and 17% said we might experience a rally within the next 6 months. So if anyone in the audience has final questions for Matt, please get those in now, and I will ask Matt. In the meantime, what are some things that we should be looking for as indicators, maybe in the coming weeks, months, that might tell us which direction the market is heading over the next 6 months?
Yeah, I think one thing that's going to be very interesting is third quarter corporate earnings. because when companies announce their earnings, they not only talk about what their results were for the third quarter, but they also talk about what their expectations are for the fourth quarter and also for next year, called guidance. And it will be interesting because analysts, Wall Street analysts kind of set their projections about where they think corporate earnings are going to be. Right now, it looks like they still are baking in a 10% increase in earnings growth over the next year, which seems pretty optimistic. They're going to probably have to revise those numbers lower. And then the question is going to be, how quickly do they revise it? How will that have an impact on markets? Or could companies come out and maybe say, look, we know that the economy is slowing, but our sales are still doing well, and we're still able to, get the raw materials we need to produce our goods. So that's going to be interesting. I think also once we get the midterms out of the way, it will just be one more question mark that's removed. But to me, ultimately, it's still the Federal Reserve. What will they say? What will Jay Powell say at the press conference? What will their statements say? How will the language change? There are people who parse the language and look for a different adjective here or there, because that's sometimes the only indication we have. But I think during the press conference is going to be interesting, because sometimes a change in tone can be enough to really indicate, hey, we start to see inflation slowing. We think maybe we can begin to pull back a little bit. There will be a lot of reading between the lines. So, all of those are important, and something will happen that surprises everyone that we don't know what it is, but it's almost certain that it will happen, whatever it may be.
Great. Yeah. We actually had a question come in about some of the tilts and what is behind that? What's SEI's, what does SEI look at when they're making those decisions? Is there any light you can shed on some of the different thoughts that go into how you position the ETF strategies, or in larger part, just some of the tilts in general?
Yeah, so we look at the current economic and market environment. We look back at history to get a sense of what has happened in the past. We try to find an area that maybe is undervalued, something that's an opportunity, and hopefully is asymmetric, so that the payoff, if we're right, is going to be more than what you would lose if we're wrong. We want those odds to be tilted in our favor. Ultimately, it comes down to human judgment, and we do have a group of people who discuss these things, debate them. Typically, for every position that you see us take, there have been dozens or maybe hundreds that the team has talked about, considered, but maybe ruled out. So, they're always looking at the market, communicating, thinking about these things, and just looking to see what trends are. And also, you want to know not only what is the trend, but is there something that maybe the rest of the market isn't seeing? Because you may know what a trend is going to look like, but if everyone knows it, the market probably already has priced it in. So is there a surprise element that may be in there? What do we know that we think the rest of the market isn't getting? Sometimes that's the hardest thing to determine. What does the consensus believe, and what grounds do we have for believing something different?
Yeah, well said. I think I got everyone's questions in, so I think we've done a good job covering everybody's just thoughts and questions at this point. Would it be possible for us to send out your slides as follow-up to attendees? Can we get our hands on those?
I'll get those over to you. Yes.
Great. So we'll send that out in the coming day or two for everyone who's joined us. We have recorded this presentation and we'll post it on our YouTube channel. So if you want to rewind some of this and go back to what Matt has said, keep an eye out for that as well. And without further ado, just everyone go enjoy some dinner and their Wednesday evenings, and thanks for attending.
Thanks,
everyone.